we are going to review 2025 and then talk to you a little bit about, of course, what we think is happening in 2026. And it's going to start with inflation, because that's really been the big story for the last 2 years and still remains absolutely the critical story, not just in economics, but of course in politics. But I think it's important to understand what is the big problem with inflation. Inflation has generally been essentially sticky. What that means is we're all used to, from many years back, of having 2% inflation, where price rises really weren't a big factor in our everyday life. That, of course, has changed materially after the COVID run-up and 9% inflation in 2022. So we've all survived the big shock of inflation. But the problem is the following, that even as inflation has come down from 9% all the way down to 3%, it has been persistent. And that, in fact, acts as essentially a huge economic tax on every consumer, even on the highest income consumers. We've all, I think, experienced the fact that prices are far higher than they were a couple of years ago, while our incomes are not. I mean, I saw today a really interesting little tweet. We talked about the fact that in 2022, McDonald's hamburger was like $3. Now it's $7. Chicken nuggets were like $4. Now they're $8. Those are 100% gains over 2 years. Those are nowhere near the 3%, 4% type of general inflation runs that we're seeing, but they're just emblematic, I think, of what everybody is feeling. That, of course, has an impact on consumer behavior. Add to that the fact that the policy of the United States has changed radically with the incoming new administration, in a sense that we've really increased all of the tariffs across the board. That certainly added a little bit of pricing pressure. Surprisingly enough, it didn't act nearly as much as people thought it would, because producers pretty much ate a lot of the increases in tariffs pressure, but it still wasn't insignificant. And then last but not least, inflation has leaked itself into services as well. Airplane tickets, general tickets, just for concerts, for anything else, or even basic services. I'm just thinking, even in my own life, cleaning services, lawn services, everything have all been 50% higher than what I was paying just 2 years ago. And I'm sure you're all feeling the same thing. So overall, this is why it's such an important aspect. It's really the central conversation of almost every economic point that we all talk about in terms of policy. What's happening to inflation and what's going to occur to it going forward?
Boris, which inflation component would you say affected traders most this year? Would you say goods, services, wages?
I think it's a good question, but I would say goods inflation has certainly tapered, and it's really become services inflation that has accelerated a little bit. As I'm sure every service you're paying for has really run up. And it's certainly, if you consider, for example, restaurant, which is considered to be services, everybody knows that every restaurant meal costs far more than it used to just a year and a half ago. I will say one thing that's sort of interesting. In the U.S. market especially, housing prices may have peaked. Now, housing is an extremely big component of inflation. And one of the things that we see in the latest data, and one of the things, by the way, that's sort of very difficult is, of course, because the U.S. government has been shut down for the last 40 days. We're very late on a lot of data. We're just relying much more on private data at this point. But what we see as far as housing inflation is that rents have really come down, and rents are the precursor to all housing costs. And because housing, I think, comprises something like 40% of the price PCE components, if that goes down significantly, we actually could see lower inflation going forward. And I think that's an interesting point that a lot of people may be underestimating. That having been said, there's been so much damage done that I think it's going to be really a couple of years of actually increasing incomes before we can catch up to even. And I think that's something that continues to weigh on economic outlook as we go forward. But of course, inflation isn't the only story of 2025. The tariff shocks were a huge story. In some ways, you could say they were a far bigger story than they merited. The consensus view, and I was actually outside of consensus on all of this. I did not think they were going to be nearly as big an impact as everybody thought. But everybody, of course, thought that, oh my God, it's going to tilt the U.S. economy into a complete depression because we're all going to be paying so much. And what turns out is actually huge amount of tariff increases were eaten by the producers. And also the increases in tariffs, ironically enough, created a much more productive, lower cost. It made the lower cost producers, the productive producers, even more competitive in the marketplace. And actually, in some ways, you could make the very, very unintuitive argument that increases in tariffs are eventually going to be deflationary because they're going to drive prices down. But the combination of, high consumer prices, the tariff shock, certainly created a lot of fears of a stagflationary risk. And what does stagflation mean? Because I think most people are too young to actually remember stagflation. Stagflation, in simple words, is literally the worst of both worlds. It's rising unemployment and rising prices. In general economics, you kind of have a trade-off. I'm either going to have lower employment, but maybe rising prices because there's a lot of demand, or I will have lower prices and higher unemployment. Higher unemployment means people spend less money, so prices go down because demand goes down, and so prices, you have lower inflation. Stagflation is kind of the worst of both worlds because stagflation, the prices are rising not because there's lower demand, but because there's lower supply. Remember, prices can rise from two factors. Either there's so much demand for a product that it gets overbid, or there's less supply of the product and it costs more. And so the tariff shock is essentially the idea of a supply-driven price rise, right? You constrict the supply of goods through tariffs, and that creates stagflationary risk. So those are things that are still a key factor, not as, I think, a grave a danger as people were afraid of, but we are coming in at a time, and we'll talk about this as the presentation gets on the way, of labor demand starting to curve itself down, prices still staying high, and you could have this very toxic brew, really, really ugly cocktail of high prices, high unemployment, which is the recipe for very, very terrible policy of stagflation, which we hadn't seen literally since the late 1970s, right? It's been so long that I'm the only person old enough in the world to actually remember it back when it happened the first time. So hopefully that's not going to happen again, but it is a risk.
When it happened the first time, what assets reacted the most?
Gold. Gold was the play. And yes, it is a play again today. So you could say, yes, everything repeats itself in cycles. But that's a great question. That's exactly what happened. Everybody ran to gold. And we'll talk a lot about gold, of course, as the presentation presents itself. But let's focus a little bit on China, because China, of course, is, like everything else in life these days, a tale of two cities. The best of the worlds and the worst of worlds coming in kind of one thing. So on the one hand, I think what's happening in China on the negative side is truly an implosion, a massive implosion of people's wealth. Because if you think about China essentially as an economy and how people save money in China, the way people save money in China is by buying real estate. Most people's savings are essentially their house, their apartment. That's where all of their wealth used to be accumulated in, and that's where they take all of their wealth and put it into. It's not like, in advanced industrialized nations where we have lots of our wealth in paper assets and other investment opportunities. They simply almost put all into their apartments. And of course, what we saw in China was this huge overbuild, massive overcapacity. Real estate, just to give you an idea of how ridiculously overbought real estate was, it comprised 25% of the whole Chinese economy. If you think about the Chinese economy, how huge it is, how it manufactures everything in the world, how it is essentially the factory for every single product that we own or have, and how it has all these advances in even technology and science and everything else. And all of that was overshadowed by very, very low technology, nothing special real estate. 25% of the GDP was Chinese real estate. And of course, that implosion just is having a massive negative wealth effect on the economy, because it created huge debt burden, which is never going to be paid, which the Chinese government is basically trying to sort of extend and pretend into forever land to be able to try to kind of annihilate through long-term remediation. But that almost never works, right? There's always debt overhangs that eventually come back to haunt you. So that is, on the negative side, a very, very serious problem. And it is not going away. You're looking at, like, I remember the latest data out of the Chinese real estate market essentially shows continuing, I think, 49 consecutive months of declining prices. Imagine if you had like 48 months of declining real estate prices and 25% of your economy was essentially real estate, what kind of a negative impact that could be. Now, on the other hand, speaking on the positive side, China does have enormous amount of strengths. It is now become not just a low-level manufacturer, but it actually, in some ways, the leading manufacturer in the world, even producing, you could make the argument, producing products certainly better than Germany, but better than even maybe Japan in terms of the quality of their production. In the electric vehicle market, they're now the leader in the world. And they're overtaking huge amount of market share everywhere that we can think of. The one place, of course, where they don't have any impact is in the United States, in North America, where they're banned from selling their electric vehicles. But I believe in Europe and everywhere else, you look at the numbers. If you think about the electric vehicle as basically a computer on tires, it inevitably is going to be less expensive than a standard gas-powered engine car, just simply because there's less moving parts. Battery technology is getting better and better and better. And of course, the ability to kind of, as I said, to think of it as a computer, you understand that all computing prices just have an inevitable move to the downside. So it could be conceivable that in 5 years, we're going to have something like a $50,000 car today could be a $25,000 electric vehicle car. We could have $10,000 electrical vehicle cars, just like when laptops. It's funny, I was just looking at a video of Compact, if you remember Compact, which was a big brand like in the 90s, laptop, when it first came out, was $4,995. That's what a laptop cost. And people were just amazed at how cheap it was and how amazing it was. And so I bring that up is because if you think about how ridiculous, you can buy a laptop now for $200 in Walmart that is 1,000 times more powerful. Now imagine if you have these kind of economies of scale and innovation in the electrical vehicle market, we could have cars for $10,000. We could have cars for $5,000. That's inconceivable to all of us who are now paying $50,000 a vehicle. But if you think about a $10,000 car that's incredibly fully functional, that has all the ability to drive well across the road with all the safety stuff, that is a market in the emerging nations market, Brazil, Indonesia, Malaysia, hundreds and hundreds of millions of consumers that have never been able to afford a vehicle would now be able to afford a vehicle. So in that sense, China really is leading the world, I think, into a very, very interesting niche.
Who do you think wins that sort of EV
I think
race?
they've won it. I
think they've already won.
I don't think it's even competition now in terms of the automobile industry, which is why you're seeing such serious problems in Europe, in Germany. Because if you think about, European industry, it's really tied to the automobile industry. That's the biggest industry in the world, and they were at the heart, the soul of it. We talk about. I was talking to somebody else. I was talking to my German friend yesterday. And he had just come back from Germany, and he was saying how disappointed he was at the quality of production of German goods, which have really gone down. I rented a VW maybe a couple of months ago at in Florida, and it was such a horrible experience that I said I will never rent a German car again. Now, imagine uttering those words 5-10 years ago when it was considered to be the absolute apotheosis of great craftsmanship. I think it's really a problem. U.S. Car manufacturers are just down basically to 2, and they're certainly not producing anything interesting or well. So I mean, Tesla is the only exception to the rule, and
that's what I was going to go for.
And and Tesla is probably the only competitor. Now, it's not a competitor, I think, in terms of car handling techniques, because BYD now has cars that you've seen these commercials where they take a BMW and a BYD and they put them on these rubberized, really, really rocky roads, and the BYD just goes absolutely smoothly, and the BMW looks like it's going to just break apart based upon its shock absorption. So I think in many ways they've far exceeded all of the driving aspects of it. But where Tesla excels, and where I think the next great competition in the EV space will be, is of course in auto driving, in essentially robo driving, and Tesla does seem to have a huge advantage on that, which, by the way, leads us to the next point, which is AI, right? I mean, it's really what we're talking about is AI for cars, and of course, AI generally is the great salvation of the world. That's really where the competition lies. That's where it's become an absolute, missile war of gargantuan proportions, billions upon billions, maybe even trillions of dollars of investments being thrown at that industry, in the great hope that not only is it going to lift mankind from just the drudgery of work, but that it's going to just completely change not just the way we compute, but the way we have robotics, the way we do all sorts of physical work, and everything else that comes into play. That war is by no means determined yet. I think that's still very much an open game, and we don't know who's going to win it. Certainly, we know today there's all sorts of announcements that is happening. It's interesting that U.S. government now is becoming very involved in the business itself. Today, there was an announcement that U.S. government wants to buy 10 current nuclear plants. Why? Because in order to be able to run AI effectively, you need so much energy and so much power that it's impossible to generate it with the current natural gas and oil and coal reserves that we have. Not just because of climate issues, but just because there just isn't enough energy to be able to fuel effectively, cleanly, all those computing data centers. So the idea is that you have to reignite the nuclear power industry, and you can't do it privately because it just requires almost like a Marshall Plan-like type of investment structures to get that back up, since it's been abandoned for so many years and it's become so obsolete. So all of it really comes back to, is AI going to be the savior of humanity? And I'm generally actually pretty positive on that idea. I think the changes that we're going to see are so radical in scope, we can't even imagine the productivity gains that will happen going forward. But for now, of course, the bears make a very good case. Well, it's nothing. It just helps you write your emails better, which is partially true, but also partially not true. It's just a very small part of what it does. But that's I think the battlefield between China and the U.S. that will determine who's going to be leading the world as we go forward. And of course, all of that spills out into greater economic growth. And as greater economic growth, we also have greater commodity uptake. And so the question is, are we going to see a greater uptake in commodities? That's a really interesting question, because right now we certainly don't. And we'll talk of course about the prospects for oil, but oil being the dominant arbiter of commodity demand, all we're seeing is just kind of very negative things going forward. So that's sort of interesting. Now, when you're looking at China and you kind of trying to explore investment ideas, investment themes, obvious things come to mind, I think, that I wanted to mind with you guys. First and foremost is that if you are better on not better, but if you're making a bet on electric vehicles, right, as a very much the forward face of innovation and transportation, we're just scratching the surface. And that surface is made with copper. Copper is the foundational element in so much of electric vehicle production. And of course, that's interesting from an investment point of view towards Australia, towards where I'm sitting right now. Not necessarily Melbourne, but on the continent, there is an enormous amount of copper mining, and that could have a very interesting impact on Australia and Australian dollar as we go forward. The other aspect of it, of course, is lithium and nickel. And lithium is a huge mining element that they mine in South America, and that could be interesting in those emerging market nations. And then the third aspect of China, the negative aspect of China, which is the constant, slow, consistent degradation of their property values, that could have eventually a very negative impact on the Hang Seng due to a debt implosion. Remember, if you're going to have some kind of a debt implosion due to just simply failure of managing all those overvalued mortgages in property market, that's very much going to spill over first and foremost into the Hong Kong Stock Exchange, which is the most sensitive to Chinese paper, right? Now, the other aspect I think that's kind of interesting this year, that's definitely worth discussing, is the story of cryptocurrencies, right? And how we've had this truly, I would say, the greatest roller coaster ride of all has been in Bitcoin, where we had this move from like 55 or 40,000 all the way up to 126,000, now coming back down to where we're actually down on the year. And we'll talk a little bit about all of the future that hangs on cryptocurrencies. The one use case scenario that I think almost everybody agrees with is the dominant reason for why cryptocurrency remains an asset that they could not kill. I was somebody I saw describe that the other day, and I thought that was really, really good way of describing it. That after all these years and all of the critics and everybody else talking about the fact that it's no better than a pet rock, it's still an asset you cannot kill, but it doesn't mean that it cannot hurt you. And we'll talk a little bit about what the potentials for the cryptocurrency are going forward and the potential corrections that can happen within it. But for now, I mean, what we do see is everything ran up and everything came back down. So on a year-to-year basis, things are either moderately lower or somewhat lower, or just on a purely speculative basis. I see we have the Dogecoin here that's down 53%. But of course, the greatest emblem of the speculation was the fart coin. And I think that one is down to like 90%. So all of those are definitely, we are seeing a huge amount of the pure speculative aspect of the crypto market coming out of it. The bigger issue is, will the real crypto market survive and thrive going forward? And I think I'm going to talk about that, of course.
Does Bitcoin bottom out around 90 where it is, or does it drop further to 75?
No, I think we certainly drop further. If you look at the history of Bitcoin, it has always rallied and retraced almost 70% off its high. However, every time it's retraced, it's actually held above the prior low, right? Not the prior high, but the prior low of the prior cycle. So I think the prior low, the high cycle was like 70, and the prior low was maybe around 40. I'm not quite sure where it was, but generally, I think it's possible for Bitcoin to retreat more than 50% on its high, which means that yes, it could go below 75. It could even possibly even touch 50 and still not break its lows from the prior cycle, which is really the key thing. But that's going to be the big technical look.
Yeah, I think you're right about the 50. I'm looking at the chart right now, the day chart, and Friday, 13th September 2024, 52,000 was kind of the low off after that bull run to 50.
Right, and that's going to be the key hold, because if you sort of believe that Bitcoin is a long-term secular bull market, it really needs to hold the lows to continue proving that. But it doesn't mean that there isn't going to be quite a lot of pain between now and then if speculative flows come out of the product. I will caution though that we always in the investment business, we're always looking for the past analogs, and the past never quite repeats itself the way we think it does. So it could very well be a situation where, hey, maybe we're done. Maybe this is going to surprise us, and 90 is it, and it's going to go higher to 150, 170, maybe 200,000. It's impossible to tell right now. But if you sort of preparing yourself for the worst, that's where you need to be looking at as a potential retrace level. Now, the other thing that happened that was interesting in 2025 that was a huge surprise was the dollar puzzle, right? What happened to the dollar? Because if you think about kind of the general basic economic analysis of FX, the country that has the best growth usually has the best currency, right? Currency is an expression of country's economic health. The higher the growth, the stronger the currency becomes. But we had a very, very unique situation where U.S. growth far outpaced European growth and even Asian growth. Yet the currency itself came back down significantly. Now, for those of you who are familiar with the Trump administration prior, in the prior cycle, there wasn't a surprise at all because Trump administration absolutely likes a low currency because it creates lots of stimulus and it creates lots of export demand for products. But I think, of course, the really underlying reason for why the dollar declined, even though U.S. growth was so strong, was because this was happening while the Fed was relentlessly cutting rates, while the rest of the central banks were either cutting them at very small increments or just simply stationary. And remember, FX is a relative game. So if one guy is stationary and the other guy is cutting, that's all you need to create massive disparities. It doesn't. The other central banks don't have to raise rates in order to stay stronger on a relative basis, because ultimately currencies are essentially ultra short-term bonds, right? And it's the yield of the currency that determines its value. Now, the yield of the currency, which is the short-term yield, which is the Fed funds rate, is really going to be a very interesting conversation. And we'll talk a little bit more about FX as we go forward. It's going to be a very interesting conversation as to what really happens going forward. We certainly know the Trump administration's feeling on the position, but we also understand that the Fed does not share its point of view at all. And we may be at loggerheads where the Fed decides that it will not cut rates any further. In fact, I would say there was a clear indication of it as possible at the last FOMC meetings. If that's the case, then staying stationary, again, because FX is a relative game, is the same thing as tightening policy. And that could actually create positive flows into the dollar, which I think very few people expect.
25-point basis cut on the next.
I vote no. I think they stay stationary and drive President Trump absolutely crazy. But I think they stay stationary. The problem is that everybody is operating very much in a fog of war situation because we don't have really, really good data. The only thing that would really motivate them to cut rates further is if they thought the employment situation deteriorated rapidly. But if we're printing 100,000 jobs or anywhere somewhere around in that level against essentially is still a relatively high inflationary period in terms of prices not coming down, it would behoove the Fed to not want to cut rates. I mean, today Atlanta Fed, which is the leading Fed that kind of forecasts GDP going forward, was forecasting 4.4% GDP. In some ways, there are parts of the U.S. economy that are just booming, and it seems almost antithetical to want to cut rates in that kind of environment. So push comes to shove, I think they stay stationary unless there's just unless the job employment data shows a significant amount of weakening, and then the political pressure will be so enormous. Then I think Trump will blow a gasket, will just literally pop a vessel if they don't cut rates. But on a purely economic policy point of view, I think the bet now is stationary, not cutting.